Joining us now is Jim Paulsen, Leuthold Group Chief Investment Strategist. And Jim, you've been pretty cautious on the stock market lately over the last few weeks, maybe even months. Are you surprised to see this big strength given some of the headwinds?
Oh, not really. I think optimism's building, Sarah, in the sense of, I think that jobs report really, it's just a 1-month report, but it set a tone of there was slack in the labor market left with labor force participation rate going up, the unemployment rate rising and still posting a 200K gain in jobs, and then no wage pressure. That's kind of a Goldilocks idea that there's room to run yet in this recovery. I don't know if I agree with that, but that's kind of the feeling it left. Of course, it's the earnings season, and we know that's going to be good, tax-induced. I think people are starting to get used to the trade war rhetoric. It's more headline risk than real risk, and it bounces back as it has again today. And then finally, I think there's some sense building that this correction or pause has gone on long enough, and it's done what it's needed to do. That is, it's revalued the stock market to some degree. It's checked optimism, if you will, and earnings now are going to continue to come through, and there's a lot of people expecting a rally in the second half. So I'm not sure I agree with all that, but I can understand where people are coming in looking at that.
That's maybe the most constructive I've heard you in a while here, Jim, because a lot of your commentary, at least in the first half of the year, was approaching a thesis of stagflation.
Carl, I still think the market's going to continue to struggle in the second half. Now, I think, as I've said kind of all year, it could just be a continued flat performance while earnings continue to rise, and we'll maybe have a decent valuation at year end to play in 19. Or it could be yet we hit an air pocket and break those February lows and create a mini panic or in a great buying opportunity. There's 3 main things I think could happen here in the second half. And one is, I don't think overheat pressures, including rising inflation, even if it's mild, including Fed tightening, and including another leg up in the bond yield, is over. I think all 3 of those are going to continue to pester us as we move through the second half. I think we're going to break 3% wage inflation, break 3% CPI, and we're going to have the 10-year bond yield reflect that, for example. In addition to that, I think there's a case to be made that the U.S. economy slows down in the second half. We're going to post a 4% quarter in the second quarter, but I think we might slow to 2.25 or 2.5 in the second half. Think about the degree of monetary tightening that has been put on the U.S. economy. We've had a slowdown in the money supply annual growth rate from 7.5% in late 2016 to 3.8% now. We've had a doubling of the entire yield curve over the last 12 to 18 months, not just the 10-year, but across the curve. We've had a tremendous flattening of the yield curve. You also have had an increase in cost for companies with commodities going back to 3-year highs, including energy cost. You're pressuring consumer budgets with those costs. Real wages have gone flat now in the last year. I think we slow down, and that could really surprise Wall Street estimates for year end.
Do you agree? Aren't we at the point now where we could see some real economic impact in terms of consumer prices and exports?
I think in the long term, you definitely could see an impact. In the near term, a lot of what we've had a bit of a tug of war between really in the U.S. very strong economic fundamentals and very good earnings growth. We've broken out of the earnings recession in a very big way. But at the same time, on the other side of the tug of war, you have a lot of geopolitical headlines such as trade wars, concerns about populist elections. And with respect to the trade, excuse me. With respect to the concerns about trade, it's something that it definitely could push up consumer prices. It's something that consumers are probably going to feel the impact. Because trade wars, in essence, they're stagflationary. They pull off that really disturbing trick of cooling down the economy while at the same time overheating prices, and that's something that I think will be spread across the entire U.S. economy. At the same time, really, there's no winners in trade wars. There's only losers.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.